Welcome to the weekly NCST COVID-19 update call. We're happy to see many of you here again and look forward to these calls certainly each week. This week we are again blessed with another guest speaker, and I'll go ahead and turn it over to Julia Gordon in just a moment to introduce her. Couple housekeeping items. Everyone is muted at this point. We will have several question and answer periods as well as some time for feedback during the call. If you would like to ask a question or answer a question, you can either use the raise hand feature. You can also put questions in the Q&A or in the chat, and we will make sure to answer your questions there. With that, I'll go ahead and turn things over to our president, Julia Gordon, to introduce our guest speaker.
Thanks so much, Erin. Well, once again, we are so excited to be able to bring a national expert to this group to talk about real estate issues that we're all thinking about all the time. And so today we're delighted to present Dr. Jessica Lautz, whose last name I've probably butchered, and who is Vice President of Demographics and Behavioral Insights at the National Association of Realtors. She focuses on analyzing demographic trends for both NAR members and housing consumers. And today she is going to present some results of some recent survey research that she's conducted on behalf of NAR. So with that, I will turn it over to Jessica, and thanks again for being here.
Thank you so much for having me. It looks like I have a duplicate here for some reason, I'm not sure. I'm supposed to upgrade my account and I'm lax on that. So I think that's probably what's going on, is it's trying to upgrade while we're on here. So I am with NAR. I've been there since 2007. That was an interesting time to join there at the National Association of Realtors. It's certainly an interesting time now. And I will say it's a different time. And so this is obviously an unprecedented time that we are living through right now. But something that's good to keep in mind is that the housing market going into this was extremely strong. We're in a different environment than we had been before. The problems that we had in the housing environment going into this global pandemic were really from a supply and affordability issue. So we know a lot of people have been cut out of the housing market and left behind the housing market because of the very tight inventory, especially for the lower end of the market, at an affordable price point where a lot of people do traditionally enter the market. That is definitely not me. So definitely an interesting Jessica Lautz there. When we have seen this, going into this, what we wanted to do is we wanted to keep a pulse on the market. And so we did a survey, and we've been doing it now for 7 weeks. And what we have seen is that the market has changed over that time period very drastically. Are you guys seeing all these Jessica Lautzes too? Okay, it's very strange, but that's okay. I'll keep going here. What we wanted to do is see how the housing market, how our members are adapting to the housing market. And so when we started the survey, we actually looked at oversamples in Washington and California that quickly became out of date. And so we started looking at a nationwide sample. What we have seen is that, of course, there are people who, the majority of buyers and sellers are saying that I need to take a pause right now on this transaction. And this is from a health and welfare perspective, not necessarily an economic perspective. So there's many sellers who are actually removing their homes from the market, which is actually tightening supply even more than what we have gone into this as. What we do expect going forward is that this is absolutely going to impact sales as we look at the next couple of months. There's no way that it can't. And there's some states that are actually restricting and saying that realtors are not an essential service at this time period. I would say that that's unfortunate because a lot of people are in a situation where they have to move, whether it's a divorce or it's a marriage or a new child, and they can't live in the housing situation that they're in currently. Because of this, what we know is that some people are moving forward with transactions if they're in a state where they are allowed to move forward with their transaction. And what we have seen is that in those scenarios, home buyers and sellers are changing their behavior. So sellers are asking that buyers come into the home wearing protective gear, that a home inspector is actually inspecting the house before anyone even steps foot in that house, so that house is listed for market, so that if they do everything virtually, so a virtual tour, a virtual listing, a virtual open house, that if the buyer does not physically come into the home, that they actually know what they're looking at virtually, so that there's no surprises if they end up purchasing that home. What we have seen over the 7 weeks is that we've actually had a growth in the number of buyers who are going through with the transaction and purchasing a home without physically stepping foot into it. And so last week, the data that we actually reported showed that a quarter of our members have worked with a buyer who actually put a contract on a home without physically stepping foot in that home, which is fascinating. And that number, will release new numbers tomorrow, that actually increased in the last week. The other thing that we're seeing is that the buyers and sellers who are in the market right now, they are there for serious reasons. So they actually do need to make this trade. It's not something where they just want to upsize just for fun. This is something where they actually do need to make this happen. So the buyers are actually seeing a median of 3 homes. Traditionally, you see about 12 homes on a market, even in a very tight housing market with low inventory, 9 homes last year was common. So seeing only 3 homes, that really does mean that they are a very serious buyer coming into this market. As far as home prices go, we are not expecting that home prices will decrease. We do expect that they're going to remain stable. That's a good thing for the housing wealth in America, so not just for someone who's having a transaction, but for homeowners. And we know that that is the most traditional way for Americans to build up their nest egg, is through their homeownership and their housing wealth. So this is an encouraging sign. And the reason why we do see this is just supply and demand. And so because we have such limited housing supply, we do expect that home prices would, if not remain stable, at least they could increase as well. But sales overall, we do expect them to go down for the next couple of months, but we are expecting a quick recovery once we can leave our homes, practice safe social distancing, and continue with transactions with that pent-up demand. The last thing that I'll say is that while a lot of us are stuck at home cocooning, there's obviously a lot of people remodeling, fixing up their home, they're redecorating, painting walls, doing things not only to kill time, maybe get a little exercise, get the jiggles out, right? But there's also a lot of people who are in this home and they're saying, this is not going to work for me for an extended period of time. So maybe I need a home office, or I need a bigger kitchen, or whatever it is. Maybe they need the yard space so they can plant their own vegetables, because you certainly can't order them anywhere. Whatever it is, I do think that we're going to see a change here coming out of this. There's been talk about people moving out of city centers into more suburban or small towns. We're already seeing that trend, and we have seen that trend over a number of years. Even young millennials, a quarter of them bought in small towns last year. So we are seeing that people do want more space, and we could see this coming out of this, but that is yet to be seen. So that's 10 minutes. Thank you for letting me share these latest results. Don't know who all these Jessica Lautzes are. Probably need to change my Zoom password after this, so not sure what's going on here. Sorry about that. But happy to answer any questions that you guys have as well.
Wonderful. Thank you so much, Jessica. So at this point, we'll go ahead and open up to questions. As a reminder, you can either use the raise a hand feature, or you can utilize either the Q&A or the chat, and we will get your question to Jessica. Great information this morning. Any questions? Oh, there's a question. Chris George, are you with us?
I am here. Can you hear me?
Yes.
Hi, Jessica. Thanks for being with us today. I'm Chris. I'm out of Detroit, Michigan. I don't know how much influence NAR has with what's going on here and if they're advocating for changes, but in Michigan, showings are completely not allowed. Realtors are essential only through the virtual showings. Do you guys have any further insight as to why we can't offer showings besides the obvious? I understand the social distancing, but why not for vacant homes? Why is there a problem with having showings in vacant homes, or not overlapping showings and crowding the house with a bunch of people? And can't we come up with something that can allow realtors to keep working, at least in Michigan. And you had mentioned people are home, they're painting and doing, we can't even buy paint or flooring in Michigan right now. Like everything is shut down. But as far as the real estate goes, I personally don't see an issue with practicing social distancing and still showing homes, especially the vacant ones. But that's my question. Does NAR have any influence as to what's going on in our state?
So I know that our advocacy team is working diligently. We do have advocacy team members who are working with their local state governments to try and give the information that this is an essential service and that it is very important if someone is in a situation where they do need to make that move. You bring up a great point about vacant homes. That is something that I saw in the open-ended comments in the survey, is that realtors feel more comfortable right now taking on vacant homes, or if someone's already moved, making that transaction happen because you can bring in buyers into that home. Absolutely understand the frustration there. I know Pennsylvania is also in that area. We are a committee-based organization, so the vice chair of the research committee this year is actually in Pennsylvania and really struggling with this and has been. And so their local advocates are really working to try and have these rules change.
Good to hear. Thank you.
Hi, Jessica. This is Marcia Nedland. You have been an absolute hero of mine since like 2008. I've really followed all of the data that you put out for NAR, and meeting you even virtually is like meeting a rock star. So there's that. But also, I wondered if your plans for the annual buyers and sellers survey are being restructured, or what your thoughts are about that for this year.
Yeah, absolutely. Well, thank you. That's huge. You see an insight into my very spacious house here, and a cat who's chewing on me. So hopefully I can scrub a little of that burn shop there. I will say for HBS, for the Home Buyers and Sellers Report, that is our bread and butter. We still plan on putting that out. I am thinking through different ways to structure it. I think that we do need to separate this year, and I think it'll be imperative, honestly, to do this, is to look at home buyers who purchased pre-coronavirus crisis. So looking at buyers who purchased before March, and then looking at buyers who purchased from March until June, to really have a better understanding of how these buyers differ, because I think we're going to see the reasoning, the type of home that they want, how they sold their home. All of these are really going to factor into the data. We also, if you're familiar with that report, you probably know that we also do a bunch of breakout reports. And so we've looked at generational trends, and we've looked at LGBTQ communities and veterans communities. And so one of the reports that we discussed yesterday actually was looking more at multi-generational buying. I suspect that coming out of this, there may be more families who say, you know, I have a senior parent or relative who was in active adult living. I don't feel comfortable with that anymore. And so we may see more families living together and taking care of each other in a different type of way. We've seen that as a rise already. So I think there's ways to do more analysis here with that data and really restructure it in a way that is helpful.
Thank you for that. A couple questions that we have in the chat and the Q&A. First one, are you seeing any reduction in sales prices right now?
No, so that is the one thing that is holding steady. We've actually seen 3/4 of sellers, and this has been consistent since we started asking the question a few weeks ago, are not lowering their prices. So about a quarter always lower their prices. So maybe they priced it too higher. They're in a neighborhood, they're not seeing a lot of buyers. It's at a price point perhaps above that 1 million mark, where you do traditionally need to lower your price after a time period if you're not bringing anyone in. So we are not seeing that at this point. We are, of course, seeing that buyers want lower prices, but I'm pretty sure we could say that for everything and any good out there. So not super surprising right
now. All right. Any trends you can see in cold markets?
Like cold temperature wise?
I'm unsure.
Okay.
Courtney Schneider, could you maybe provide some additional detail? Are we talking cold temperature? Or are we talking markets that haven't seen a lot of action? Maybe let's go on to the next question, Jessica. What volume change has happened to foreclosure over the last 3 months?
So we don't actually track that data. The best place to grab that data is actually from Adam Research or CoreLogic. They do track that on a regular basis. We have heard about, of course, forbearances, the ability to work with your lender, and you'll want to work with your lender if anyone's in that situation. But we don't track that ourselves, and we don't expect that would increase. At least not in the short term, especially as home prices are expected to at least remain flat.
Sure. And some clarification on that cold. It is cold as in markets that haven't seen any action for a while. She's in Dayton, Ohio. It's been mainly considered a cold market.
Yeah, absolutely. So it's going to be rough in a lot of areas. So areas like Pennsylvania, areas like Michigan, where people are on more lockdown, we do expect that home sales are going to take a bigger dive there. And especially if you're in an area where it has been hard to move homes, I think the market is going to change, and I do expect it's going to shift. Though I'm not a mind trader, and I don't have a crystal ball here. I wish I did, but I do think that there could be some changes where people do move to different areas, perhaps even back home, that they haven't traditionally looked at. So I suspect there could be some shifts here.
Great. We're going to go to a live question. Adrian Knight, you might need to unmute your line.
Hi, Jessica. Thanks for taking my question now. So you said you don't believe that there are going to be any changes in the values of homes?
We don't. And the reason why we don't is that we went into this crisis with extremely tight inventory, especially at the affordable price point of the market. And we went into this with such a short supply, and now people are taking their homes off the market, even if they were listed. So the buyers who are in the market, they're acting quickly. We've talked to big brokers in Seattle area, and I think looking at Seattle and some parts of California, it's a good idea to kind of see where we're going as a nation, because they locked down first, they peaked first, and now they seem to be in a place where at least they are thinking about coming down and off of the peak. I have relatives in Seattle, so I'm saying this very warily, thinking about my older relatives themselves. My godmother's mom, who turns 103 this month. So I'm thinking about this in a way that I don't want them out. I don't want them going to Starbucks like they want to. That being said, there are people there that once a home comes onto the market, it's being snatched up very quickly and being purchased, because people are still in a situation where they do need to purchase homes. And so they're really dire for inventory in that area right now. And so I think that we could see that demand for housing coming out of this will continue to increase.
So Jessica, I want to be cognizant and appreciative of your time here. We do have 2 more questions. Do you have time to answer those 2 additional questions? Super. All right. So first one is, what are the trends with refis? And I'm not sure if that's something that you're monitoring right now.
Yeah, definitely. Refis absolutely spiked. I can't remember the exact percentage, but it was some astronomical percentage of increase. And this was, I think, about 6-7 weeks ago at this point, where rates went down to as low as 2.3 that you could get for a 15-year fixed loan. That is very low. That's something that we have not seen historically. And so a lot of people did take advantage of that. That being said, lenders got very backed up with those refi loans. Then it became even more difficult to even find that rate. Rates have been fluctuating quite a bit, but there are still people who are taking advantage of these historically low rates. I do expect that refis over this time period, we may see that rates bounce around and people could take advantage of them. You'll definitely want to work with your lender if you can take advantage of that rate for sure. That being said, that could mean that people are refining into a home where perhaps they were thinking about selling originally. We did see that happen in the first couple of weeks of the survey. We actually took that pulse and said, are people removing their homes from the market and refining instead? And we did see that a few people were doing that as well, which will just tighten inventory even further.
Right. next one is, and I think you've touched on this a little bit, but maybe not the entire question. Are you noticing a decline in appraisal values, or do you not have that input yet? And are appraisers proceeding with caution?
So we do have a question in the survey asking about delays in your closing. And I will say that only a third of transactions that currently have contracts are not seeing delays. So the vast majority are seeing delays. That doesn't mean it's not going through and that there's contracts being removed. There are, of course, but the vast majority are just being delayed, and appraisals is one of those. So people are feeling more comfortable having their appraiser wear all the protective gear, mask, gloves, etc. People don't feel super comfortable with having someone else inside their homes right now for refis or purchases. So both of those are being impacted by that appraiser, by the home inspector, both of those coming into your home.
Perfect. One last question that I see right now, and then, we'll certainly, it looks like we have a hand raised, but increase in short sales, is that something that you're seeing right now?
Much like foreclosures, we're not seeing it yet. It's possible that it happens, but we aren't seeing it yet.
Okay. And Chris George?
I just got one more question here. Touching on, I like where we're at when you say there's going to be a low amount of inventory, so prices can remain the same. That makes total sense. What about, are you guys looking into the fact that, see, we sell a lot of homes in lower income areas. What about the buyers right now that aren't able to save down payment money, or not, are in that, have that financial burden? I can see, houses, the higher end homes, guys that have money, and they're going to buy a house either way. But what about the buyers right now? They're not able to save that money. Is that across the board, or is just going to be a buyer for any house, But do we expect a dip maybe in lower income areas possibly?
Yeah, that's a great question. So I've had similar questions that have been, as well as when we look at the job loss, which has been heartbreaking in many areas and in many sectors. I will say a couple things. One, the job losses have been traditionally along, and we're breaking this out by state actually, and we're putting this out on Thursdays, have been traditionally more in the renter community, have been on the younger, lower end of the spectrum. So when we look at these individuals, they may not necessarily even have homeownership on their radar yet because they may be younger, out of college, in college currently, and unfortunately losing their position. And that is heartbreaking, I will say that. The good thing is that the CARES Act did bump up the unemployment insurance, which is a good thing because it's higher than what we have seen traditionally, and it's for a longer period of time than what we've seen traditionally on just the state level. That being said, sure, it could be more difficult for those individuals to enter homeownership right away. Hopefully this is not a permanent hurdle. Hopefully we do have restaurants and haircuts rebound, hopefully for my own sake. But I do think that a lot of us really want those businesses to reopen, and as they do, those people will have jobs again. The other good thing that we are seeing is that in those communities like Washington State, like California, there was a lot of hiring, and there's a lot of hiring in specific industries. So people who lost their jobs in the service industry, they were able then to move to warehouse, temporary. This is not a permanent thing. This is not probably their dream job, but it is a temporary arrangement where hopefully it'll give them a little money.
So if I can take the privilege of asking the last question, we are hearing reports that lenders are starting to place overlays and constrict the credit box somewhat. There was news out of FHFA today that hopefully will help with that. But I want you to talk about what you see in terms of access to credit going forward, especially for, with the folks who are on this phone, many work in an environment where they see a lot of FHA loans and first-time home buyers.
Yeah, absolutely. Definitely saw the news last week on JP Morgan Chase having 700 credit score, 20% down payment, which is completely unrealistic and out of reach for your first-time home buyers out there. We actually, in response to that, put out a down payment report that looked at what we have seen for down payments over time, going back to 1989, and we've never seen a 20% down payment, even for your repeat buyers. It's just not something that happens. And traditionally at least. So yes, absolutely, this is a concern. This does happen, unfortunately, in markets like this where lenders get very scared and they start placing restrictions on having buyers enter the market. And yeah, that's a point of concern. Absolutely.
Well, we will hope to join with your organization and advocacy around that.
Yes, and I know that our advocacy team is working around the clock on a lot of different issues, and this is one that's absolutely on their radar.
Perfect. Julia, I think that's all the questions that we have.
Well, Jessica, thank you so much for being here. As you can see in our little community here, you are a rock star, and we are delighted to have been able to have you on our call today. Thanks so much.
Thank you so much for having me. I'm going to go change my Zoom password now. Thank you.
Thank you. All right, I think we'll move on to policy. Julia, you want to provide an update?
Sure. So probably everybody who's read the paper in the last 12 hours saw that it does appear that Congress is moving forward with legislation to provide additional money to the small business support that ran out pretty much instantly previously. I imagine there are a number of folks on this call who have applied for these small business loans. And I also imagine there are a number of you, I would love for you to add any comments in the chat about this, who may not have received that funding, either because you never got into the queue or you never found a financial institution that could get you into the queue, or you may have been told you were approved but never actually received the funding. I would love to know what people's experience is out there if this is something you've applied for. The good news is it appears that we will soon be having an additional $310 billion go into that program. Estimates are that the program needs even more than that, but this should, if I'm looking at various numbers and it feels like 80% or so of the requests should be able to be covered at that point. There's also a set aside within this program for funding to go out from smaller financial institutions. So there's about $60 billion in two different $30 billion buckets that will be set aside for CDFIs, credit unions, and other smaller financial institutions based on their own particular size. And that will, hopefully allow some of this money to bypass the problem we've seen so far, which is very large financial institutions providing their services in an unequal way to their bigger clients over their smaller clients. In fact, there's already been a lawsuit about that against the four largest banks in the country. So we'll see what happens with that. Nice to have lawsuits, but the problem is that people need money right now in order to keep their business operational and keep people on the payroll. And if later we find out somebody did something wrong, it's pretty hard to put Humpty Dumpty back together again. So, I really hope all the new focus on this program will help the money go out to the small businesses around the country and nonprofits that really actually need this money at this point. That particular bill, which is focused almost exclusively on SBA with a small amount of funding going toward medical and testing issues, that was a bill that folks in DC were, referring to as the COVID 3.5 bill. So now everybody's going to be turning their attention to the 4.0 bill. It is expected that there will be another larger, less targeted piece of legislation that will pass at some point. Really no indication of how quickly, The housing community as a whole, in particular, is being very, very vocal around the need to have housing much more robustly in the next bill. There are folks from both the single family side and the multifamily side in these conversations. The housing mantle is largely being carried in Congress by the House Financial Services Committee and by the Senate Banking Committee. So I would look to them for, being the ones to be speaking out on the behalf of those of us who work in housing, particularly in more underserved communities. And we have talked before about the issues that NCST is in particular focusing on, but as always, we remain very focused on any kind of program that's going to help with rehab and with keeping the vacant foreclosure inventory flowing, and with trying to have some legislative provisions that would help protect first look type programs or even expand first look type programs to make inventory available directly to owner occupants and to folks doing what our buyers do, as opposed to what will otherwise be a big opportunity for, well-funded cash investors to potentially snap up properties. I think what we heard from Jessica is, of course, that right now we're not seeing a lot of foreclosures, we're not seeing a lot of defaults, and we're not seeing these home price declines, which then themselves turn into drivers of default. So, holding our breath right now that housing will not take too big a hit, but I don't think it's unreasonable to assume that at some point after this all passes, the economy is not going to look exactly like it looked before. And I do expect we will see an uptick in foreclosures, and it will be important to make sure that we can keep those properties in good condition and that we can get those properties back into the hands of homeowners whenever possible, or into the hands of responsible landlords who will rent them in a way that is supportive of your community goals. So that's what's happening legislatively. On the regulatory and sort of non-legislative policy side, I want to talk a little bit more about that last question I asked Jessica before concerning overlays, because this is something that NCST is spending a great deal of time thinking about, is what are the impacts going to be on access to credit, particularly for borrowers with FICOs under 700, borrowers who need lower down payments, and borrowers who are not who are purchasing homes that are lower priced. So far, the news is not good in that, unlike the last crisis, there's nothing about this crisis that has been driven by bad underwriting. There's no evidence of bad underwriting. Most analysts will agree that most of the mortgages out there in the marketplace right now are well underwritten. There is no evidence that borrower behavior has changed in any way that is that poses more risks for lenders. The problem is, when you have a hammer, every problem looks like a nail. And what the lenders know how to do is tighten the credit box. And what they know how to do is tighten it along the two dimensions that have traditionally driven pricing, which is FICO and LTV. So that's happening now. It is happening both in the very explicit sense, as folks saw from the JP Morgan Chase announcement and a few other lenders, which is that they are explicitly putting out new limitations with respect to FICO and LTV. And I'll talk in a minute about why that is. But we also see it happening in pricing. And that's a function of the G fee, the Fannie Freddie G fee, and the loan level price adjustments. And it's just a function of how pricing works. Interestingly, I've been talking to analysts who see the pricing changes as being driven largely by fears about liquidity rather than fears about credit risk. That suggests that if the various levers that are being pushed and pulled right now inject enough liquidity into the market, that we should be able to sort of chill out this credit contraction a little bit. I am concerned, though, that lenders are much easier to impose overlays than they ever are to relax them. That tends to, it's sort of like, not that I'm speaking from personal experience or anything, but much easier to gain the 5 pounds during your COVID quarantine than it will be to lose that 5 pounds later. So this is an issue we're keeping a very close eye on. There was a significant development this morning when FHFA announced that it would continue to be able to accept or to not put back to lenders loans that were made and then went into forbearance after they were made. There are a lot of caveats around this, and FHFA didn't totally throw the barn door all the way open on this, but moved enough that some of the fears in the market are likely to chill out a little bit. But continuing to work on making sure that lenders know they have a secondary market execution is really important. And to go back to those really explicit overlays from JP Morgan Chase, it was explained to me by their lawyers, literally the reasons for those overlays is those are the parameters they use for their portfolio lending. And they are assuming right now that every single loan they make will be held in portfolio because they won't have a way to sell it. So really keeping that liquidity flowing is really important. It will also be really important to make sure mortgage servicers don't go broke. FHFA also made a move this week that was helpful to that respect, in that they aligned the requirements for non-bank servicers, saying that non-bank servicers will only have to advance payments to investors for 4 months rather than 12 months before the secondary market entity starts to pick up those payments. So lots of efforts to inject liquidity into the system, to keep the housing market from seizing up, to keep the housing market as something that's strong in the economy rather than an additional drag on the economy. But all of these things are very fluid and potentially very impactful on what we do. So we'll continue to keep an eye on them and report to you. So any questions?
So at this point, let's see. First question here, what can be done as a national group to see these changes to requirements for credit are unhealthy and not supportive of growing confidence in the economy? Thoughts on that, Julia?
Sure. Well, as a national organization, we do speak out on most of these issues. As a 501c3, we have the ability to do a small amount of congressional lobbying. And so we do try to take advantage of that. And there are those of us in the DC office are in touch with the relevant Senate and House offices right now on these issues. We also have very strong relationships with a number of the regulators. And by strong relationships, I mean, we have someone we can talk to, not that they'll necessarily listen to us, but we have been very active in coalitions, both coalitions across the whole mortgage industry, coalitions more on the nonprofit side and the lower income side to try to help support the housing market as best we can. For example, last week, NCST worked with a coalition where we were a lead member to issue a letter to all the relevant regulators asking for additional liquidity support in the field. What we specifically asked for, and you can read our letter on our website, was that this liquidity should be made available to mortgage servicers as long as it was very clear that it would be used to support the provision of appropriate consumer relief and to continue business operations, as opposed to being used for, say, executive bonuses that otherwise might not be able to happen. So that's something we've been a part of. And in terms of these overlays, we also are working in coalition with folks like NAR and other national organizations to make it very clear that we do not believe that either homeowners or aspiring homeowners should be punished, in a sense, for something that was not of their doing, and that is really, a global pandemic is something that, is totally exogenous to this system. And that as long as there are borrowers who do have the income on an ongoing basis and the reserves to be able to enter into homeownership at a time like this, that they should be able to do so. So we haven't done this yet, but we may do this on some of these regulatory issues, which is go out to all of you and ask for sign-ons for letters. And we are trying through our newsletter and our website to let you know when there are comment opportunities at these regulatory agencies so that you yourself can comment, because the single most important or most impactful thing that happens during any regulatory comment period is not that the big national groups weigh in, but that local organizations weigh in with very specific stories about how what the regulatory agencies are doing impacts them and their communities and their business. So hope that's an answer to your question.
Julia, and I'm going to go ahead, just because you've touched on a lot of great things and a lot of great resources that can be found on our website, I'm going to go ahead and transition the agenda slightly to get to something that we wanted to get to last week, and based on lots of questions, which was fantastic, we weren't able to do that. But we want to go ahead and do a quick demonstration of specifically our COVID-19 resources page. And I know also that there was a question of how folks start to receive our newsletter, and I will have Mariah touch on that. But to start with, I'm going to go ahead and transition our call to Dawn Stockmo, one of our community development managers, and I'd like her to walk through our website.
Great, thanks, Erin. And I'm sure that many of you have already been to our website, but if you have not, it's stabilizationtrust.org. And if you can see my screen, this is the front page. There's a number of different places where you can get more information about who NCST is, what we do, how to get involved. I'm going to just show you quickly the policy and advocacy piece since Julia referenced it. And so different publications that we've had, different comment letters, all of those are posted under this section under advocacy. So there's lots of really good information on our website about that, a little bit about who we are. And then the good stories that you all submit to us, we also post on our site under our stories. So I would encourage you to continue to use this as a resource. What we wanted to do is show you a little bit more right now on the actual COVID-19 resource page. So it's when you log in, you'll be able to see it right away. If you click on the read more section, you will see this table of contents. All of these conversations that we have on a weekly basis are uploaded to the resource page if you're not able to attend in person. We've got the COVID policy agenda. One of the things that we think is useful, again, are these different resources. And so we want to make sure that what we post on the website is useful to you as practitioners. And so anything that you think that we should have up on the site, please make sure that you send them over to us and we will get them up. Updates on the CARES Act, any federal announcements. We also have the state-specific resources. So depending on where you are, if there are resources that you're looking for in your particular state, we are trying to keep those as current as possible as well. So if you have anything that you would like to make sure we get put on our website, please make sure that you let us know those things. The other thing that we talked about last week, which I want to make sure that we touch upon again, are the stories from the field. And while there is a difference between our buyer stories, which are the more specific before and after pictures, here's what happened to the property, here's who benefited because this property was rehabbed. The stories from the field, which we're pushing out on our social media platforms, are really the random acts of kindness types of things that each of us are probably running into every day, given this situation that we're in at the moment. So please make sure as you're doing your work, as you're having conversations with folks, that you are keeping track of those things and then sending them over to us so that we can push them out on your behalf as well. So with that, I will go ahead and turn it back over to Erin.
Wonderful. Thank you so much, Dawn. And I definitely encourage folks to go out to our website, take a look at the resources. And I just noticed in the chat, JR, fantastic news on the funding piece. We'll go ahead and add both of those links to our resources page for our Chicago buyers. Some good things are definitely happening with regards to funding, especially for emergency housing and low-income folks. And so that's fantastic. Thank you. At this point, we've got a few more minutes. I'd like to turn things over to our local market intel section, where we want to hear from you. What's happening in your neighborhoods? What's happening with closings? How are things going with financing and rehabs? So if anyone has some information they'd like to share with the group, I know it's very helpful for others to hear from folks that are experiencing the same types of things. That can either go in the chat, the Q&A, or certainly a raised hand, and we can talk with you. Anyone have updates to share this week? Got a hand raised. Whoops.
I'll just toss out that I'm in the desert Southwest, and in terms of the housing market, it's hard to tell there even is a virus going on. It's really very busy, both with refis and with sales. Some people are hunkered down for a while and got cold feet, but what I hear from the lenders and realtors that I know is that it's very, very busy, very strong. But the virus, this is not the environment that New York State is in, for example. So not yet anyway.
Thank you so much for that, Marcia. JR, are you there?
Yes, I was trying to put it in the chat, but I want to say, acknowledge that there are resources out there we're seeing lately for folks doing housing work. So I just wanted to acknowledge that with CDFIs and LISC, L-I-S-C, I always forget what it stands for. LISC communities are putting a lot of resources out there for folks doing housing work, whether it's emergency housing, transitional, low income, or home ownership. And they're also putting more resources out there so folks can maintain these properties throughout this crisis with the holding costs. So there are a lot of resources out there in terms of the Midwest and Chicago I've seen lately. I was surprised by it.
Thanks so much for that, JR. Yes, Lisk is one of our founders and definitely a huge supporter of all things local community buyers. So we'll make sure and also add Lisk information on our site in our resources so that everyone can have the benefit of that. Any other stories from the field this week?
This is Marcia again. Just one more thing I want to add that I kind of wish I had asked Jessica when she was on is, just to remember that minority communities are suffering the virus in a way that's different than other communities. It's worse. And I know in another call, some of us on this call heard harrowing stories about minority neighborhoods in Chicago. And so I would love, wherever possible, as we move forward, to ask people to, look at their data, compare race information, as well as just presenting us with an overall story, because I think it's a different story.
Absolutely. Thank you so much. Julia, I think we can go ahead and wrap up. I'm not seeing additional hands raised or questions right now.
Okay, well, we are, as always, so glad that so many of you are continuing to join us on these calls. I know there are some people on this call who have been here every week, some of you who are here for the first time. We did put out a survey that's closed now, getting some feedback on these calls. I want to put this out there since it's not at the half hour yet. We did receive not specific feedback to NCST, but I read in somebody else's newsletter that some local organizations were saying to the national organizations, stop having all these calls and webinars. We don't have any time to do our job. We want to be here to do this as long as this is useful to you. Obviously not mandatory for our local partners to be participating, but we may, if we get feedback from you, either, well, I see we're getting some feedback from JR right now. We could go to an every 2-week type call. We don't want this to be difficult, but for us, it is important to be in touch with you and to be able to do the two-way information exchange where you hear some things from us and from outside speakers. And frankly, for us to hear what's on your mind is really important for our advocacy work, because I cannot tell you the number of conversations I'm in, whether it's with official policymakers or just other groups, where there are things I've heard from some of you that nobody else has heard before. I'll just give you an example, which is there's been a lot of talk about the announcement of FHFA waivers around the need for appraisals in a certain period of time. But then I've heard from some of you, wow, sometimes you're being asked for a second appraisal. So that's, that kind of information is really important, and we want to be able to keep doing it. So thank you again for being here. Of course, be in touch with us anytime, even between calls, and we'll look forward to talking again soon. And everybody stay safe out there.
Thank you so much. Have a great day.